Hello and welcome to the next lesson. So we're going to start talking about stationarity, co-integration, pairs trading, and all that wonderfulness. In this lesson, I'm going to teach you how to model a stock. We're going to just probably use SPY, but how to model a stock using the principles of co-integration and stationarity. And so part of this is identifying a pair or a stock that is closely related to SPY that we can use to calculate sort of the fair market value of where SPY should fall. So the first thing that we need to do is we need to identify a pair for SPY. And how we're going to do that is we're going to open up TradingView. We're going to go to indicators and we're just going to find a correlation indicator. I am going to use my own. It is publicly available. I don't really know if there's a lot out there, but you can just use mine. So ticker correlation matrix table and heat map is the indicator. Once we open this up, we have a correlation table. It's defaulted to 75 days back, and we can see the relationship of various stocks and how they affect each other. We have SPY here. We can see obviously it affects itself perfectly. QQQ is high, UPRO of course, DIAL, that wonderfulness, okay? So we could use any one of these tickers to do a pair relationship, but we want to have something a little different. Let's see if we can find something with an inverse relationship to SPY. So we can add a couple of different things. I like to add the currencies in because the currencies tend to know what's up. There tends to be some really unique things that you can find with the currencies. We're going to do USD CAD. We're going to do Dixie. We're going to leave XLE, but we're going to maybe change UPRO to Dixie. Let's see what we have with this. Okay, so we can see that we have some pretty substantial relationships here, especially with USD CAD, Dixie, I have two Dixies. I wanted VIX. Let's change one to VIX. Okay, so yeah, we have negative 0.85, negative 8, perfect. Now this is over 75 days. What we want to see when we're looking for a pair is a stable relationship over time, and we want to try to get as far back in time as we can. So we want that relationship to exist as far back as possible. So let's start expanding our look back period. So the correlation length we're going to expand to 250 days. We're going to see we lost a lot of significance. Dixie dropped a lot. VIX is still pretty stable. I don't like using VIX alone just because it remains within the same range, right? So it's really difficult to model, and explaining why that is will be for a later video. It's okay to use the VIX if you are using two pairs, but I don't want to just model SPY after the VIX. It's not going to work based on how the VIX works. And we'll talk about that a little bit later because it's kind of complex. But we see the VIX has a good relationship, but we're really looking for Dixie or XLE or something else. So we're going to try to go back a little bit further. Let's go back 500 days. Okay. Here we go. So we see the VIX drop to negative 0.52, and we have Dixie at negative 0.75. Now, the reason Dixie is at negative 0.75 here and not at 250 is because it's doing what we want it to do. Co-integration generally means that there is a cyclical function. So the stocks diverge, and then they meet back up in the middle. They reintegrate, they diverge, they reintegrate, they diverge, they reintegrate. So Dixie looks like it's going to be an ideal candidate. So what we're going to do is we're going to actually export Dixie and we're going to export SPY and make a model from Dixie for SPY. So we can either export SPY and then export Dickey separately and then just paste them together. But the easiest way to do it is just by using Pinescript. So we see Dickey, it's on the TVC exchange. So if we go back to SPY, we can open up Pinescript. We can make a variable called Dickey. We're going to use our request security function, which we've used time and time again throughout these videos. So request security. Now our symbol, we're not going to use sim info ticker ID. We're going to use Dickey because we want to call Dickey. So the exchange, we need to put in the exchange and the ticker. So the exchange was TVC. Then we're going to use the colon and the ticker is Dickey. So now that's going to call Dickey. Our time frame, we can leave it at default, and to leave it at default time frame, we're just going to do quotation marks, and our expression is going to be close. Now we can plot Dickey. We're going to title it Dickey, and then we're going to add this to the chart, and we can see there is Dickey. So now what we can do is we can export this data, export ISO time, and the data is exported. Okay, so now we have our data. We can recall close as SPY just to keep this making sense. So the first thing we're going to do is rerun our correlation assessment. So if you remember how to do that, we go to data, data analysis, and we're going to use the correlation function. So correlation, okay. We're going to highlight SPY and Dickey, labels in first row, and we're going to say okay. And there we go. We have a -75 relationship. Let's see how far back this goes. So we're just going to create, this, because if we remember, we were looking at 500 candles. I think we may have got our 500 candles. We did. We're a little bit over 500, but that's fine because the relationship is perfect. So we're going to go ahead and just delete this. We don't really need it. So the next thing we need to do is we need to calculate what the SPY value would be with the Dickey value of this. Now we can do this two ways. We can do this in TradingView using the SPTS indicator, which we've talked about before, or we can do it right in Excel. Let's keep it easy. Let's just do it right in Excel. We're going to create two variables, one called slope and one called intercept. For our slope function, we're just going to go equals slope. We're going to open this. It's going to ask us for known y's and known x's. Our known y's are what we want to predict, which is SPY. And our known x's is what we are predicting from, and that is Dickey. And then we're going to close that off. For our intercept, we're going to use equals intercept. Again, known y's are SPY. And our known x's are going to be Dickey. All right, so now that we have this, we can create a new variable called cointegration. We can use the sum function. We're going to use Dickey times the slope. Make sure to lock that cell using the function F4 or the $, plus the intercept. Again, make sure to lock it. Enter. Okay, so then we can see what the fair value of SPY is going to be versus depending on where Dickey is at, right? So we can see here fair value would have been 461. It was at 438, so it would have been a long. If we look at where we should be right now, we should be at 406, but we are at 440. All right, so we can't just accept this because we have to check stationarity. And what stationarity refers to is whether there is the same statistical processes driving this value as is driving Dickey and SPY. Now, because this is the cointegration is a function of both Dickey and SPY, we don't have to check Dickey and SPY individually. All we have to do is check the actual cointegration to make sure that it's exhibiting stationarity within itself, because elements of Dickey and elements of SPI are embedded within the co-integration relationship. So we don't have to check SPI and Dickey independently. We can just check stationarity of the co-integration relationship. And that might sound complicated, but once we go into how to do it, it's going to be really easy, okay? So to do this, we need to use a test called the augmented Dickey-Fuller test. We're not actually using the augmented version. We're just using the simple Dickey-Fuller test. So we need to create 3 variables. One is called x, the other is called delta x, and the third is called lagged x. Now, delta x just means change. Delta in statistics, in physics, in anything just means change. Lagged means a value behind or in front. So first of all, calculating x is the easiest. We're just going to use the sum function, and we're going to subtract this from SPI, and that is our delta, or that is our x, sorry. Our delta is the change, right? Because delta, again, means change. So when we're calculating the change in x, we're just going to minus this and this. And then we're going to drag this down. Our lagged is going to be just lagging our x, and then we're going to drag that down, okay? So now we have all of the variables we need to calculate our Dickey-Fuller test. And we can calculate that one of 2 ways in Excel, and I'm going to show you how for both ways. So the first, most simplest way is just to create 2 variables, coefficient and standard error. We're going to highlight these two cells here. Make sure you highlight them. This is really important. Then we're going to go up here. We're going to go equals line est for line estimation. Again, it's asking us for our known y's. Our known y's in this case are going to be our deltas. So we're going to do delta. And our known x's are going to be the lagged values. Now we're going to do comma, and it's going to ask us for a constant. So for the constant, we can either use our intercept or we can use 0. When we're doing the Dickey-Fuller test, we want to use 0, okay? Because then it's going to approach us as close to a negative value as possible. Then it's going to ask us, do we want to return additional regression statistics? We would put 0 for no and 1 for yes. Because we need the coefficient and the standard error, we're going to put 1 for yes. We're going to close off these, whatever you call them, and we're going to press Control Shift and Enter. Now we need to press Control Shift Enter, or else it's going to not give us both of our variables. And we need these 2 variables specifically, okay? So once we have those 2 variables, we can divide the coefficient by the standard error, and there is our t statistic. It is called a t-statistic. Do not confuse it with the t-test if you are somebody who has statistics or math experience. It is not the same as the t-distribution. It is different. So you cannot use the t-distribution. Just keep that in mind. If you don't know what the hell a t-distribution is, it's fine. Don't worry about it. So our t-statistic is negative 2.7. The other way we can test this in Excel is by using the data analysis tool. So if we go up to data analysis, we can use regression. Our y is going to be our delta. And our x, again, is going to be our lagged value. We're going to, we're going to go ahead and we're just going to put it in a new worksheet. We're going to press OK. It's going to give us a bunch of data, and all we really care about is this t-statistic here, okay? So we can see the t-statistic is negative 2.718, and that is significant. It is the exact same as we have calculated ourselves. Before we can actually accept this as significant, we actually have to look at what the t-statistic is compared to critical values. So what we're going to do is we're going to consult. I just pulled this offline. This is the t distribution for the Dickey-Fuller test. So we have our critical value at 10% confidence, at 5% confidence, at 2.5, and at 1%, okay? We're using the no constant, no trend. We can have a constant and no trend and a constant and a trend. We're going to get into these other model types in the future. Right now we're using no constant, no trend, and we need to make sure that our value falls below one of these values. It does, it falls below the 1% confidence. So we have a 1% confidence that we are stationary, okay? There is stationarity in this data. Okay. Now that we have this information, what can we do with it? Well, we can create an algorithm in Excel to tell us when to buy and sell SPY based on Dickey. But what we want to do is we actually want to take this information and we want to put it right directly into Pinescript ourselves so that we can create a Pinescript model of Dickey and SPY. So we're going to open up TradingView. We already have our Dickey here. We're going to get rid of this plot function. Let's create a new variable called SPY. We're going to multiply Dickey by our coefficient. So let's pull this up. Our coefficient is our slope. So negative 3.067. We're going to just copy that over. And we're going to open up TradingView. And then we're going to go and copy over the intercept, which is 833.216. And then we're going to paste that into our model here. Then what we can do is we can plot SPY. Let's just change the line width to 3 so it's easier to see. In our indicator header, we're going to do comma overlay equals true because we want it actually overlaid with our chart. We're going to have to actually delete this, and then we're going to have to re-add it to our chart. Okay, so now we have our Dickey and SPY co-integrated relationship overlaid on the chart. Now we can't go back here because our model is only back about 500 days, which is about here. We can verify that by using the period candle counter just to make sure that we are operating within the model parameters. And yeah, we are. So we are starting here and going here. Now that we have this model overlaid, we can just take a look at how effective it would be if we just sort of look at some of this stuff. So say we got in short here, we're not going to sell until we have a crossover of our co-integration. So if we shorted really anywhere up in here, it would have been a 6% gain. We could have longed down here and got out multiple times. We could have longed down here, got out multiple times, shorted up here. And the wonderful thing about using a pair or co-integrated relationship is you have a lot of time to sort of just let your position faster because you don't really need to get out until you cross your co-integration trend, right? So you could have longed anywhere here or anywhere here, and despite the tanking, you would have still been able to get out, right? Because if you longed here and you forgot to take profits at this cross and we tanked more, well, you could have just taken them at this cross because this is stationary, right? It's remaining relatively constant. It's not going up at the speed of the stock whipping back and forth because you have the market participants who are generally idiots, and they're whipping the stocks up and down. It's, you're going 5% one day, 10% down the next day, 18% one week. You're just going all over the place, right? The stationarity filters that nonsense out and it's like, okay, this is where SPY or whatever ticker you're doing should be. And you see it's not moving to the extreme that the SPY is moving, that the market is moving, because this is all noise. This is noise driven by a bunch of stupidity. And the stationarity of our model is just filtering that stupidity out. And it's like, this is the fair market value of SPY. No matter what these idiots are doing with the stock, this is the value that SPY will reach at some point once reality catches up to these people that are whipping it down and whipping it up and whipping it all around. So there's no urgency with this type of trading. And this is why I like pair trading, but it is a very slow strategy. You are holding for much longer than if you're a day trader or if you are a short-term swing trader, right? You're holding on average longer, but there is less urgency to get in and out of your positions. So you generally will get in below the co-integration setup, and then you will long it across. Now we can use some things to help us trigger an entry, and generally what pair traders use to help gauge an entry is actually z-score. And like I said in I think like the first video, get used to the z-score formula because we're going to be using it a lot. So if you remember it, we're going to do it. It is close minus the average, and we calculate the average by using the ta.sma function, close 14, divided by the standard deviation, which is ta.standard deviation, close 14, and there we go. Now we got to create two Boolean variables, which are true or false variables, that are determining when our stock is overbought and oversold. So we can make something called overbought. And my definition of overbought in terms of z is greater than or equal to 2.0. And we have to add a qualifier because z being 2.0 is only part of the equation. We also need to be above our co-integrated relationship. So z being greater than or equal to 2 and our close being greater than our co-integrated relationship. So that is overbought. Oversold is going to be the inverse. So z is going to be less than or equal to -2, and close is going to be less than our co-integrated relationship. Now, to plot this, we can use a function called bgcolor. It just means background color. We're going to ask Pinescript to determine whether overbought is true, and how we do that is we just type in overbought question mark, which is literally asking overbought true. And if it is, we want Pinescript to put a background color of red. Or is represented just by this colon here. Is it oversold? If so, then we want to see color lime. And if it's neither of those, we just don't care. So put no color. Okay? So now that we've done that, let's see what it looks like. All right, so now we have our oversold and our overbought entries. Okay? Now the next thing we can do is we can backtest this. And how we can backtest this is by simply taking the meat of our indicator, which is essentially just these few lines here. We can copy it. We can go to open, new strategy, and in between these long and short conditions, we can paste in our indicator information. Okay? Now, all we have to do is convert our overbought and oversold into a strategy entry and exit. So our long condition is going to be oversold. We have to add one more thing here, though. We need to add when we're going to close our long condition. So let's add a variable called close long. And close long is going to be when our close crosses up over our co-integrated formula. So to determine that, we're going to use a function called ta.crossover. We're going to say when close crosses over SPY, which is our relationship, then that is a close. For our long position, we're just going to rename this long because we need to title it for our closing. So if close long, then we're going to use strategy dot close, and we just gotta say whatever we called our long condition, which we called it long. So we're gonna close long. Now our short condition is going to be the opposite. It's going to be if SPY is overbought, and our close short is going to be if we cross under. If close crosses under SPY is when we're going to close our short condition. So short condition, we're going to call short, keep it simple. And if close short, we're going to use strategy close short. Okay, now let's add to the chart and see what happens. So now you'll see a bunch of stuff popped up. Our entries and exits are all popping up here, there, everywhere. What we can do is we can go to strategy tester. We can open this up and see, okay, so our percent profitable is 88%. Our profit factor is 129. Our average trade is about 107%. And we've done 9 total trades. Okay. Now, we really just want to isolate our backtest results for when we started our model till now. So remember, our model started back here in October of 2021. So to control for all of these other things, let's use the deep backtesting function. And we are going to go back to October of 2021 till currently. We're going to generate the report and let's see what happens. So our percent profitable is 87.5%. Our max drawdown is $31. Our average time in a trade is about 24 days. And our net profit is $142. And that is from trading with $100. So we can see our margin long is 100. Our margin short is 100. You can change this to whatever you want. It doesn't really matter. All we want to know is how successful this is and whether it's a profitable strategy. It is 87.5% successful, and it is a profitable strategy. We made $50 from 8 trades from $100, right? So it is a profitable strategy, and it confirms that our model is doing what we made it do. So there we go. That is it. That's how you do a co-integrated pair relationship, and that's how you program that into Pinescript and use Pinescript to backtest it. So that concludes today's lesson. We will be doing a lot more about pair trading and co-integrated relationships. This is what's called a market neutral strategy. So you don't need to take any bias here. You are shorting, but you're not shorting under a bias. You're shorting just because we're over the expected range and value of where SPY should fall, right? So SPY should fall within this range. So you're shorting till it gets there. When it drops below, you're longing. You're not adopting any overarching bias. And if you were to follow this trade through 2022, you would have done better than most people that were just shorting, calling the end of the world, right? Because there were plenty of long opportunities in 2022 if you were just trading market neutral, right? Whenever we were down below this relationship, you could have got in there and longed it back up, right? So it's a great strategy. I do like it. It's a bit slower, but it is great if you want to start looking into market neutral strategies and not really adopting an overarching bias. As of now, the position would be to short SPY back down to a cross down. Right now would be around a move to 409, 410. And it's going to remain in that range for quite some time, even if this just continues pushing up. Because remember, it's stationary. It's not moving as dramatically as SPY is moving, okay? So hopefully you learned something from this. If you did, like and comment below. If you didn't, then sorry. All right, thanks everybody, and take care. Safe trades.